Ho ho, and welcome back to Lamb's Cryptoverse. There's been a lot of confusion and arguments about whether or not we can get a Santa Claus rally because the market ain't acting well. Well, today I feel like it's an appropriate time to discuss my proprietary, meaning I created it myself, equity sentiment risk indicator. So let's get started. There are different ways of reading sentiment. You've got the Fear Greed Index from CNN. That's for equities, basically. Then you have a version of that for crypto. Or you can look at other asset classes. Obviously, if crypto's crashing, no doubt about it, stocks are probably crashing, especially growth stocks. You can look at internet search trends at Google. You can search bear market, bull market, and you could see what people are looking for. You could look at options data, implied volatility. You could look at skew. You could look at the put to call ratio. You could look at the CFTC data. That's futures data. What's the positioning of futures traders? And lastly, you can look at proprietary indicators. That's where I come in. So let me tell you a little about my risk indicator. It's called the sentiment risk indicator, and what it does is it uses certain elements or factors that go into certain fear and greed indicators that you see on YouTube or on TV or on internet. It's calculated on a weekly basis. I do it by hand. I've been working on it like forever. I mean forever. And I've been forward testing it for 20 years. And it uses some kind of moving average and measurement model. I have to go to my Excel spreadsheet to figure out what that is. I'm not going to tell you anyway, even if I knew. And it needs to be more back tested, not because it doesn't work. I want to provide more data and more granular data to see if I can pinpoint ways of making it better. It works better during market bottoms, that's for sure. It definitely does a better job when there are some capitulations rather than picking market tops. And it's very useful for DCA. And the range is about like generally if it's above 6, it's bullish, and below 3 to 4, it's bearish. So let me give you some examples. I'm basically going to show you 3 main time periods that included bull and bear markets, and you can see yourself how the indicator worked. So the first one is the tech wreck and leading to the tech wreck. So it gave a sell signal on the beginning of January, and by March of 2000, so it gave its sell signal in January 2000. So by March of 2000, the market had reached its all-time high, especially in the NASDAQ. And that was the beginning of the tech wreck. So it worked, but it was a leading indicator. It led the market, I should say, by 2 months, which isn't too bad. Of course, one would like to lead the market at even shorter basis, meaning maybe 1 month instead of 2. But I'm still happy with that because when people look at the 210 yield curve, the 210 spread, sometimes they say that it predicts recessions, but it predicts recessions sometimes 1 to 2 years before. So I'm not really sure that's leading in predicting recession. So you want to be as close as you can to the market top and bottoms. So let's go to the next one. The next one is September 11. Basically, there was a huge bear market between 2001 or even 2000 and 2002. Basically, after the tech wreck, and then we had the terrorist attacks of obviously September 11, 2001. And you can see it had given a pretty low number, almost a 4. Before it started declining even rapidly. But it gave a really strong bullish signal on or thereafter September 11. If you remember that the stock market actually closed in the days following September 11. And so basically, as soon as the market opened, it gave a very bullish signal, and then the market rallied. But one thing I noticed, and it took me years to figure this out, during true long bear markets, it tends to go up and down. It tends to get one capitulation stage, but then it seems to signal a lower, yet still bullish number, but afterwards, as there's like a long, drawn-out bear market. That's when investors get apathetic. So they may not be capitulating, but they're apathetic. And that's what I'm going to show you here, where it said that we had a bear market in July, and it was wrong. But then soon thereafter, it predicted correctly the bear market bottom in October of 2002. So let's go to the next phase I want to talk about. And this is the phase of the financial crisis, preceding it and during the financial crisis. So preceding the financial crisis, the indicator gave a few bearish signals. I don't know if you remember this time period, but it was very volatile because it looked like we were getting, like the market was going to crash, I should say, because it looked like there was going to be a subprime crisis, and then it stopped. Then it looked like we're going to subprime crisis again, and then it stopped. So my indicator seemed to be following that. So it predicted the decline in whenever that was. I guess it was April, May, or July, I should say, of 2007, because the indicator was below 4, so it was very bearish. And then the market went down, and then it got bullish again. And then the market went up, and then it quickly became bearish again. And then the market slowly grinded down. And then it became bullish again right here. If you see where my finger is, where I highlighted it, where it says there was a Bear Stearns fire sale. If you recall, JP Morgan was sold thanks to coordinated efforts with the Federal Reserve. It was sold to JP Morgan at this time. And here my indicator picked up on that market bottom, that short-term market bottom. So then the market went up like quite a bit. And then the market topped, and my indicator almost became bearish. So what I want to say, in the bear market, these indicators go up and down, and they tend to pick up capitulations and phases of the bear market. And so here there was an up phase of the bear market, and my indicator, as we reached the short-term top, it became bullish or nearly bullish. Then it became, of course, I'm trying to remember what this was. It shot up to probably the all-time high at this time, to around 10.5. And of course that was, I forgot to label it here, that was the Lehman event. And soon thereafter, the market rallied, but it was only a short-term rally. And that's what I'm noticing with this indicator. It does make mistakes. So it looked like this is the bottom. What this was a capitulation event. And we saw that in the previous page. We saw a capitulation event, but that was not the major market bottom. Major market bottom took time, and there was apathy. So major market bottom was actually in March of 2009, and it actually correctly signaled that. It gave a signal of 8.5, so that's a bullish signal, literally at the bear market bottom. So it's confusing, right? Because the indicator seems to, in the bear market, it shows you the short-term tops and bottoms and capitulations. But you really don't get a bottom until you see this buy signal occur at least 2 times. And so I think we covered everything except one more thing, the Greek crisis and the Euro crisis. It accurately gave a strong buy signal of about 7.8 during that Euro crisis back in I guess about May, June of 2010. So let's go to the next page. So here I'm covering a few events. I'm covering the U.S. sovereign debt. It wasn't a debt crisis, but it felt like one because it was a rating downgrade from S&P and I think Moody's too. They downgraded our sovereign credit rating, and that's why it gave a strong signal of 8. And you can see that correctly predicted the market bottom at that time, around end of 2010. And then it gave some signals here. And like I said, it does a better job predicting market bottoms than market tops. And here it gave many signals during that bull market phase. It gave many bearish signals. But it did, if you look here, end of 2014, it did correctly predict the top of the market in around 2014. And then it correctly predicted the short-term bottom in December of 2015 when there was the announcement of the Brexit vote. Remember that it was a huge ordeal, the Brexit vote? And then it correctly predicted the end of these short-term corrections. You can see one in December 2017. I feel like I'm always saying December. And it again in December, it correctly became bullish. It was around 6.5. That's one of the highest ratings, most bullish ratings going back to 2015. So it became bullish around mid-2018 when the Fed was talking about raising interest rates and liquidity was tightening. And so you saw growth stocks go down and crypto went down sharply at this time. And you can see it gave a strong buy signal. So that was correct. And then it became bearish just before the February high, just before COVID hit. And then when COVID hit, it gave the highest reading ever, or maybe as high as a reading we saw on September 11, 2001. So this reading was around, I think it was around March 20th, it gave this very high signal. So that was correct. Then it became bearish around 2021, but it was early, so I'm not sure how accurate that was. And then it gave, and now we're in, because there's a new regime change, right? Starting in 2022, the Fed started raising interest rates aggressively. So now we're in another bear market, and it's doing what it did the last 2 times, where it's given short-term bull and bear signals. I'm going to show you for this year. So you can see it became bullish at the short-term bottom. Then it started almost getting bearish again. Then it started getting bullish again at the short-term bottom. I think that was June of 22. And now the market's been going down the last few weeks in December. And you can see it's starting to get moderately bullish yet again. And this is why I think we might get a Santa Claus rally, because the indicator, and I adjusted it for today, the most recent reading is above 7. So it's moderately bullish. So it's not very bullish. It's not a bear market bottom, but it is saying we can get a Santa Claus rally. So there you have it. I think, repeating myself, that there is a chance we can get a Santa Claus rally for the end of 2022. However, for a bear market bottom, I think we're going to need data that's outside sentiment. So first of all, we need to see a higher number of this indicator. I would like to see it go back to 8 and above, to it being a bear market bottom. And I would like to see, like I said, outside data supporting a bear market bottom. What I mean by that is I want crypto to be bullish, and I'm not bullish on crypto yet. And I want confluence from other equity indicators and also macro. For example, the Fed is not done raising rates. They're not even done raising and holding them. So I want them to at least be in a period where they're holding rates. And also we're not seeing confluence from other data, like the CNN Fear Greed Index. I would like it to be higher. And I would like to see more fear in the futures data, but that's for another presentation. So thank you all for listening. Please spread the good word. and like us and tell your friends to subscribe to us. Bye-bye.